Hi everyone, my name is Teacher Ilona Smith and welcome to my channel. As you have all requested, I've gotten this request quite often for the grade 10 forms of ownership video. This is a very important chapter. You do it again in grade 11 and you do it in grade 12 as well. So if you understand it in grade 10, you're basically just halving the work for yourself when you get to grade 11 and grade 10. It's also quite a big chapter in grade 11 as well. So I would say pay a lot of attention to this chapter because again, it's just going to make it much easier for you once you move up the grades. Alright, so just a little introduction before we get started. So in this topic, we're going to look at all the different forms of ownerships. I don't want you to confuse forms of ownerships with companies and types of companies because there are different types of companies. So this is more, I want to start a business, but what is my form of ownership going to be? How am I going to own this business? Am I going to be a sole trader and do it by myself? Am I going to start a partnership, private company, public company? You get the gist. So I want you to focus on more the word form of ownership than what type of company you are starting. As it says here, we are going to look at the characteristics, the advantages and the disadvantages of each. In grade 11, as I said, you also do this as well in one of the chapters, and then grade 12, you do it again. This is a textbook that I've made use of for the slides for today. For business studies, we do need to write everything as per the textbook and use keywords, but write it word for word. So I have used the information word for word from the textbook because the learners need to study it that way. Therefore, making my videos that way, I just feel benefits the students and it's better for them in the end run if I make the videos as per their textbooks. Just note that the government notes are slightly different, but you can definitely use this video for context and understanding as well. I do not take any credit for the information in these slides as I'm using them for knowledge and content purposes, and I do take all credit for the owners who created this book and who have provided us with this content. All right, so forms of ownership. All right. So this refers to like a legal position of the business and the way it's owned. An entrepreneur may decide which form of ownership will best suit their type of business. The form of ownership is described in the diagram. It says below, but I've put it just next to it. So we can see there all the different types of ownership. So if you want to start a business, again, you need to look at how am I going to start this business? If you start a sole proprietor, which is another word, is also sole trader, but we will use the word sole proprietor for the purpose of this video. If you start a sole proprietor, which is a business that you start by yourself, and it's basically, call it a one-man band, can you move further and actually register as a private company once your business gets bigger? Of course you can. You can do that as well. So just know that that is an option. But not to confuse you guys, but you can do that as an option as well. So we're going to look at what all these different ownerships mean, what are the characteristics, and what are the pros and cons, advantages and disadvantages. And this will help the business owner in deciding when weighing up the pros and cons, which business he should rather start and what form of ownership to choose. All right, so there are a couple factors that we need to consider before we start choosing this form of ownership. Okay, so the new business owner needs to consider the following. Okay, very nice question. It could have a describe, explain, or discuss before this. So discuss the factors that need to be considered. Describe the factors that need to be considered. A lot of the times I found in business studies, they just use that, we call it an action verb. So describe, explain, discuss, outline, advise, recommend. And if you just put that word in front of the heading, it actually makes a question. And that's normally how the questions are created for the exam papers. All right, so we need to consider the startup cost and the future capital. So if I'm starting a baking business, which maybe in the beginning doesn't need a lot of money because maybe I've already got all the pans and the trays and all the molds to make the cakes and the muffins, and all I need to do is buy the ingredients, right? And I have the electric mixer, I've got the oven, I've got the everything. Then it makes it a lot easier to start that type of business. So maybe a sole trader will be an option there. But when we're looking at like a 3D printing business and you don't have a 3D printer, well, then situations become a little bit different, because we're going to need to look at the startup cost, which is going to be a lot more in comparison to starting our baking business where I'm just baking biscuits and cakes from home. The size and the nature of the business. So the nature, what type of business am I starting? Is it a shoemaking business? Am I starting my own clothing line? Am I baking biscuits and cookies and stuff? So we need to look at what is the nature of the business and also what is the size. Can I start this business by myself, or am I going to need employees from the get-go? We need to look at the tax implications, because it is taxed differently depending on the ownership that is chosen. How the business will be controlled and managed, as well as the management structure. The risks that are involved. The capital that will be contributed goes hand in hand with the startup cost. Okay, the profits and losses that will be shared. So just as an example, a sole proprietor is just me, myself, and I. Therefore, I get all the profits, but I also get all the losses. If I'm starting a partnership, well, that's different. Now we have to share it, and there's going to be a ratio when it comes to that. So the profits are being split, but on the other hand, I've got more people that are helping me make decisions. I've got more people that can help with capital contribution. So that's where we again need to weigh up the pros and cons. Who is responsible for the debt? Is it either going to be by the business or by the individual? Again, depending on the ownership we chose. What is the lifespan and the continuity of this business? So in some forms of ownership, if the owner dies, the business falls away. In other forms of ownership, it can continue even if an owner or a director has passed away. The vulnerability of the business in terms of lawsuits and legal persons. Okay, new business owners will also need to consider whether the business will be a profit-making business or a non-profit-making business. So all businesses are profit-making businesses on the get-go, but on the flip side, we do have a non-profit business and company. So we need to see where are we sitting. Are we looking at making a profit or more community-based? We want to help the community, uplift the community, but understanding that then we're not going to make a profit. All right, so here are the differences between a profit and a non-profit company. Okay, another very nice question. Distinguish the differences between. Describe the differences between. You getting the drift? Okay, so a profit company is formed with the aim of making a profit. I think that explains itself. A company incorporated for financial gain for its shareholders. So it wants to make money for its shareholders, people involved in the business. Profit organizations are responsible for paying tax based on their profit. So the amount of profit that you're making is going to depend on the tax that you'll be paying. Versus a non-profit company. This is formed for charity purposes or to promote social and cultural activities. A non-profit company is an association, incorporation, not for gain. So we're a profit company, we're looking for gain, we're looking to make a profit for our shareholders. Non-profit, we're not looking at that, we're more looking at upliftment of the community itself. Non-profit organizations are not required to pay tax on their net income. Then we have the classifications between a profit and a non-profit. So the classifications: private companies are reflected as proprietary limited, or we can use Pty Ltd. Personal liability companies are reflected as incorporated or Inc. Public companies are reflected as limited or Ltd. And state-owned companies are reflected as SOC Ltd, right? Which means state-owned company limited. Non-profits are reflected as NPC, which stands for non-profit company. So you can see the different types of profit companies, and then you have the non-profit company. All right, so what are the factors that we need to consider before choosing the form of ownership? We first have a sole trader. Let's get into it. Sole trader, right? Again, we can use the word sole trader or sole proprietor, whichever floats your boat. It is the same thing, and according to my knowledge, whether you use either one, you'll still get it correct when you are answering questions in the exam paper. So, a sole trader is a business that is owned and managed by one person. So there's a first keyword. It's managed by one person and one person only. The owner is responsible for activities and decisions of the business. The sole trader mainly depends on his own resources. The business is generally a small-scale business. So again, that's where I'm talking about the bakery. You start it by yourself, you manage it by yourself, and you do the bookkeeping, you do the baking of the biscuits, you do the packaging, the selling, you do everything, but you also profit off everything too. So, nice question there would be define the meaning of a sole proprietor. Okay, then we're looking at the characteristics, right? So there's no legal requirement regarding the name. Okay, so you don't have to look legally and register the name for this business. Legally, the sole trader and the business are not separate entities. Okay, let me explain this a bit. So when we talk about separate entities, okay, I'm an entity myself. I'm a person. If I start a sole trader, they see myself and the business as one person. So if the business is not making money, right, and I'm behind with my debts, they are going to come to me and they're going to start taking my assets. They can take my vehicles away, they can repossess my car, they can repossess my couch, my TV, whatever assets they need, because myself and the company are basically one person. So when we're talking about separate entities, there are other forms of ownership where they are seen as separate. So if the business is struggling and there's debts to be paid, they cannot come to you as the owner in your personal capacity and take your assets. Whereas a sole trader, they do have that. So again, we can already start seeing the pros and cons here. A sole trader may be started without performing any legal formalities and registrations. So you don't need to register the business, you don't need to register the name. You can basically just, today you want to start, I don't know, teacher Ilona's biscuit making classes, whatever. And you can start your business. You don't need to register it. There's no formalities in that case. Right? There may be some persons to help, but ultimately the control lies with the owner. So you can have employees, but all the responsibility and all the ownership stays with the owner themselves. The owner has a personal interest in the management and the services that are rendered. It's their business. It's their, call it like little baby that they're growing. Of course they're going to have an interest in it. Of course they're going to want to put a lot of effort into it, right? Because it's their dream and their vision that they're putting into this. The owner has unlimited liability. The business dissolves when the owner dies. So there's the one where I said, does it have continuity? No. If the owner dies, the business dissolves. All right, so what are the advantages, first of all, of a sole trader? Okay, we're also going to look at the disadvantages. Another nice question is, distinguish between the advantages and the disadvantages of a sole proprietor or sole trader. It is easy and quick to form a sole trader because there is less capital needed. You can take quick decisions because you have full control. You don't need to wait upon the board of directors or the other partners. It's yourself. So you can make decisions quite quickly and quite easily because you have full control. The owner can take steps to eliminate waste of any kind. Okay. All the assets of the business belong to the owner personally. So that's where I said so they belong to the owner personally. So if I'm going to buy a fridge for the business or a freezer or maybe an oven, I myself, in my personal capacity, teacher learner herself, owns that piece of asset or equipment, not the business, right? Because remember, here we have a one-man band. So remember, sole trader is one person. There's only one of you. Therefore, everything that happens affects you. You make all the decisions. You take all the responsibility. You provide all the capital. You also own everything in your personal capacity as an individual themselves and not as the business. There is personal encouragement, personal contact between the owner and customers, because again, most of the time in a sole trader situation, there's only going to be one person running it. So you have that one-on-one contact. You don't have your sales team talking to the customers. Normally when a sole trader begins, it is just yourself running everything. Sole traders are generally closer to their customers, so they can offer more personalized approach and a more improved customer service. Now we're looking on the flip side at the disadvantages. So, since all the decisions are made by the owner, the area of the business will be limited to the management abilities of the owner. So, person starting a business doesn't have very good management skills, disadvantage for the business, right? So, because you don't have that expert advice, you don't have other partners that you can partner with and talk to, it's just me, myself, and I. So if I make a bad decision, I'm going to have to take responsibility for that too. It's not always possible to attract highly skilled workers because the capital is limited to one person. So again, that's why I said they normally start as one person because you're starting the business by yourself, right? So you might not even have enough money to pay to get a person to help you with your business. The owner has unlimited liabilities for debts. So this means that the owner personally is liable for all the debts of the business. So again, it's going to affect the owner themselves if they get into a debt situation. They cannot expand the business operations because of limited liability. The owner is responsible for providing all of the capital that's needed, which can make it difficult to raise large amounts of money when we need it. Yes, when a business is growing, yes, we'll have more capital. Yes, we can do more things. But let's look at, again, you are sitting at home and you want to start your own business. These are the things you need to look at. In the beginning, you're not going to be able to expand. You might not even be able to rent an office space. Or you might not be able to rent out a bakery, so that you're going to have to do everything from home at first, essentially. And expanding might be a problem because you just don't have the capital that's there in the beginning. If the owner does not have enough knowledge and experience, the business may fail. That's where we go. Again, we're tying into the management abilities. So if you don't have, maybe you're really good at baking. I keep using baking as an example. Sorry about that. I am a baker myself and I love baking biscuits for the family. On like a Sunday, I'll just bake pancakes, or I'll just wake up and bake scones or muffins. Lately been trying to bake bread. There's been a couple flops and a couple mistakes and mishaps, but I think I'm getting the hang of it. So I keep thinking of the baking example just because, sorry, that is another passion of mine on the side, I guess. Call it a hobby. Where was I? So you might have the really good skills to make really nice cakes and decorate them. But do you know how to manage money? Maybe not. And that could lead to the downfall of the business. A sole trader lacks continuity, especially in the event of death or illness. So again, there's that disadvantage. If the owner dies, the business falls away. The risk of unlimited liability forces many sole traders not to expand operations beyond a certain point. So because if I'm going to buy anything on debt, I'm personally reliable, it makes it a little bit difficult. I might not want to expand, or I might not want to expand a lot, because of the reason that I might be putting myself in jeopardy. Tax is calculated according to the progressive income system, which is a maximum of 40%. Now let's move over to partnerships. Okay, so defining a partnership. This is an arrangement where parties, known as business partners, agree to form a business for their mutual interest. Okay, this can be friends, this can be family, this can be just random people that you met online. Whatever the case is, 2, 3, 4, 5, even 10 of you decide that you're all going to start a business together, and you're all going to have ownership within that business. Okay, so it is an agreement between 2 or more people, meaning there's no max there. So 2 or more. So if I'm just one person, then I'm a sole trader. But if once I'm 2 people, then I can be classified as a partnership. Okay, we combine the labor, the capital, and the resources towards the common goal. So the nice thing with a partnership is you've got more people. More people means more experience, more knowledge, more capital as well. The partners may be individuals, businesses, or combinations. Partners share the responsibility of the business, and they share the financial and management decisions of the business. So sole trader, you make all the decisions by yourself. With a partnership, you have to consult with all the partners before making a decision. So what are the characteristics? So there should be at least a minimum of 2 people. Okay. Partnership agreement becomes the basis of the association between the partners. So again, sole trader, 1 person. Partnership, 2 people. But it's an agreement. We're going to get to it a little bit later. But there will be an agreement of what is the ratio. Are we going to split it? Let's say there's 2 people. Are we going to split it 50-50 with the profits and the losses? Are we going to split it 30-70, 40-60? You get the gist of it. So that's the agreement that we're talking about. So the basis of the partnership is based on that agreement and what we have agreed to already. Partners combine capital and may also borrow capital from financial institutions. They share the profit according to the partnership agreement. That's one I explained with the different ratios. Partners share responsibilities and they're involved in making the business decisions. Every partner in the business has unlimited liability and jointly and severally liable for the debts of the business. So again, similar to a sole trader, there is no difference between the partners and the business. So if the business is failing and there's debts to be owed, they can come take from the partners themselves as well. There is no legal requirement regarding the name of this business as well. Partners share profits made, and therefore they are motivated to work harder, because the more hard work I'm putting in, the more rewards I'm reaping, right? So there's that motivation in there to want to work harder. The partners have no legal personality, and therefore there's no continuity. Okay, legal personality meaning, okay, when a person is registered, they are a legal person, legal entity. Because this business is also not registered, it's not seen as a legal entity by itself, it comes with the business. So again, the partners die, the business dissolves as well. The partnership does not pay income tax, only the partners in their own personal capacity. So they pay their own personal tax, not the business paying tax. Auditing of financial statements is optional. Now the advantages, on the other hand. Each partner is going to obviously bring their knowledge, their skills, their experience, and all their contacts to the business, which gives the business a better chance of succeeding, because you're not just a sole trader working by yourself. You're now more than one person, and therefore there's more experience, more knowledge, more capital, right? But all the partners have a personal interest in this business. Again, the harder I'm working, the more money I'm going to be making. The workload and responsibility is now shared between the partners, and each partner can focus on their own strengths. So partner A is really good with finances, then we put him to do the finances and the bookkeeping. Partner B is really good with the baking, then he can do the baking. Partner C is really good with the ordering of the stock, ordering of the ingredients, delivering to the customers. That's what he can focus on, right? So with a sole trader, it's just me, myself, and I, where you need to do everything and you might not be good at bookkeeping and stuff like that. Whereas with partnerships, there's more than one person, so they can actually use their strengths to their advantage. The partners invest new capital into the business, so there is that financial expansion. Again, because there's more people involved, there's more capital that can be contributed from each individual. Partners share responsibilities by decision-making and managing of the business. Partners are not compelled by law to prepare these audited financial statements. Partners are taxed in their capacities, which could lead to lower taxation, and this will depend on the level of income from each individual. So just like a normal person working in a job, they get taxed on how much money they're making. This is exactly the same. So each owner is going to be taxed on the amount of income. So if you're sitting at you only receive 30% of the profits, well, you're only going to be taxed on that 30%. Whereas the other partner that's being taxed on 70%, obviously he's going to be paying more tax. But it could lead to less taxation in the long run. Partnership profits made, and therefore there's that motivation to work harder. Okay, I hope you noticed that. That's a bullet from the characteristics. Study them together, halving the work. Now the disadvantages. So partners might still find it difficult to raise capital, as not all the partners can contribute cash. The partners are jointly and severally liable for the actions of the other partners. So yes, we all need to make decisions, but we decide to take Sipo's decision and he makes a bad decision. We all have to take the rap for that because we're all in this together. The partnership has no independent legal existence distinct from the partners. It will dissolve upon resignation or death of any one of the partners. Okay, partner resigns, a partner dies, the partnership falls away. Can they start a new partnership? Yes, but again, then we need to start a new business, and we also need to have a new agreement. Partners do not have separate legal personality. The partners are personally liable for the debts and the losses incurred in the business. So if the business is a failure, everyone's going to have to take the rap for that. And again, it's also you in your personal capacity, not the business by itself. Different personalities and options of the partners could lead to conflict and disagreements because we've got different personalities. Yes, we can all bring our expertise, but we sometimes may struggle to make decisions because we don't all agree and we don't all come to the same conclusion. Each business partner is legally responsible for the joint liability of the partnership. The partnership has unlimited liability, which means the partners are at risk at losing their own personal possessions. So again, business is struggling, they can come take your own personal assets like your car and your TV, maybe even your house, right? Discussion between the partners can slow down decision making, like I was saying, because they may disagree on an important decision that needs to be made. a large partnership, the partners may struggle to agree on business issues. Why? Because there's so many people involved. There's so many people. Now we need to come to one conclusion, and maybe everyone's disagreeing and everyone's fighting and there's conflict, and we don't actually get to the resolution and the conclusions that we need to come to. Partnership lacks continuity. This one's a bit of a repeat from the previous one, but you can write them both because why? They're in your textbook. Okay, so if a partner dies or retires, the partnership needs to dissolve, and therefore, like I said, a new agreement needs to come into effect. All right, so let's look at the differences side by side between the sole trader, sole proprietor, and the partnership. All right, so with the sole trader, got cute little images there. Okay, this is an individual who owns a business entirely by themselves, one person. Then we have a partnership. This is by two or more people intending to make a profit, which remember they are splitting this profit. Now, side by side, can they ask you this as a question to differentiate between the two? Of course they can. Okay, so a sole trader is an individual who owns a business entirely by him or herself. They take the decisions quickly because there's only one person. The profit goes to one person, to the owner. Versus a partnership, here it comprises of two or more people intending to make a profit. There might be a delay in the decision making because we need to have all the inputs of the partners considered. And then the profit is therefore also shared amongst the partners according to their agreement. So that's the main differences between a sole trader and a partnership. Now we're looking at a closed corporation, CC. Okay, so definition. A closed corporation, a CC, is a legal entity with legal personality, meaning you and the business are separate. Not like the example of the other two. So you and the business are seen as separate. Business is struggling, doesn't impact you, your personal life, and your personal possessions. Okay, it is a business that is owned by members. So in this one, we're not calling them partners, we are calling them members. And it can be between 1 to 10 members. Okay, the maximum is 10. So anything from 1 to 10 members. The CC can be owned by individuals or by other entities. The word close means that all the members are involved, okay, and they participate in management. So, what are the characteristics? The CC has a minimum of 1 to a maximum of 10 members who share a common goal. The name must end in the letters CC. Members of the CC both own and they control the business. Profits are shared in proportion to the members' interest in the CC. So similar to the other one, there might be a different ratio depending on the profit shared. A CC has its own legal personality, okay, which means that there is unlimited continuity. One of the members dies, the business can still continue. Why? Because it's seen as separate. Each member contributes some assets and some services towards a corporation. Audited financial statements are not required. They only need to appoint an accounting officer to check and monitor their financials. Transfer of a member's interest must be approved by all of the members. So if someone wants to resign and leave the closed corporation, then they need to see how are they going to take that person's interest and share it amongst everybody else. The advantages. So a CC is a legal entity and it has continuity of existence, meaning someone dies again or retires or resigns, the business can still continue to operate. There are fewer legal requirements than with a company referring to a private, public, and so on. A CC is not required to hold an annual general meeting. Meetings are not compulsory and they can be held on an ad hoc basis. Ad hoc basis meaning we don't have to have a meeting every Monday. We can say to everyone, all right, today's Friday, let's schedule a meeting for 3 o'clock. And then everyone comes together and at 3 o'clock we decide and we have a meeting, right? Members have limited liability, meaning they can only lose what they have invested into the business. Okay, so unlimited means that I can take from the business and the person, right? The individual. Where limited means no, you are only limited. You can only take from the business and what the person has contributed. You cannot go and take their personal assets and their personal possessions. Why? Because the business has I'm looking for the word, a legal personality. A CC can be converted to a private company and members may become shareholders. A CC can invest in a company and become a shareholder themselves. Transfer of ownership is easy as it can be transferred to an individual if all the members agree. CCs may be exempted from the CIPC from auditing its financial statements. CIPC is basically the council where they register businesses. Now the disadvantages. So there are no directors, meaning that the members are going to run the business on their own. There's no like directors as such. There's limited growth and expansion because a CC can only be from 1 to 10, can't exceed 10 members. A member of a CC can be held personally liable for the losses if the members acts are found to be negligent. So, like I said, they are separate. But if you are being negligent and you may be stealing the money from the business and you're doing fraudulent acts, well, then we might be able to take your possessions in your personal liability and you're going to be personally liable for the losses because you were not doing the right thing. Audited financial statements may be required when applying for the financial assistance. All members must agree to transfer the members' interests. This could be difficult if members leave or they have to pay a member their portion. Every member acts as an agent of the CC and the CC is bound by the member's actions. The reason this is a disadvantage is if there's a wrong decision made, all members have to take responsibility for that action and all members have to come to an agreement about what and how they're going to manage this business. It is not possible to sell a CC to a company because companies cannot be converted into CCs. Most CCs face double taxation as it is taxed on their income as well as their dividends. Dividends is the money paid to shareholders. Righty, then we're moving on to a private company. So the definition. A private company is a company whose shares may not be transferred to the public for sale. Okay, so they can have shares, but they can't sell it on the JSE and sell it publicly. Okay. It is a legal entity. So again, legal entity, legal personality, same wording. The business is separate from the owners. And its operations are less strict than that of a public company. A private company is a company that is privately held for small businesses. It has to register as a taxpayer in its own right. So the business registers as a taxpayer. Characteristics of a private company. A private company can have unlimited numbers of shareholders. However, it needs one director and one shareholder. Okay, so you can have unlimited shareholders, right? But one director and one shareholder is actually the requirement. The liability of the shareholders is limited to the number of shares that is held by them. Raising capital by issuing shares privately to shareholders. The name of the business must end with the words Proprietary Limited or Pty Ltd. The company has a legal personality, therefore it is unlimited in continuity. So even in the case of death, insolvency, bankruptcy of any of the shareholders, the business can still continue. A private company is not allowed to sell their shares to the public. Profits are shared in the form of dividends in proportion to the number of shares that are held by those people. It needs to be registered with the Registrar of Companies by drawing up a memorandum of incorporation. The Companies Act imposes personal liability on directors who are knowingly part of carrying on the business recklessly or fraudulently. A private company must prepare annual financial statements. Annual financial statements need not to be audited or independently reviewed. So they need these annual financial statements, but no one needs to review or audit them necessarily. All right, then we're looking at the advantages. I see I didn't put it in my slides, but these are the advantages, right? So a company can continue to trade even if one of the shareholders dies or they resign. It is managed at least by one competent, highly skilled director. So there has to, like I said in the previous slide, there has to be one director. And the benefit is that person can be really competent and highly skilled, which will be a benefit for your business. Shares must agree to the sale of transfer of shares. Shareholders' liability is restricted to the number of shares that they own. Information in a private company is only available to the shareholders. Not required to file annual financial statements with the commission. Shareholders can appoint the most capable directors to manage their company. The company has its own legal identity and shareholders have no direct legal implications, therefore limited liability. Business is struggling, they're not going to take your personal possessions, they're not going to take your personal items because the owners, the directors, the shareholders are seen as separate to the business itself. A large number of capital can be raised since there is no limit to the number of shareholders. It is possible to sell a private company as it's seen as its own legal entity in its own right. The management of the company can improve since directors are appointed by the shareholders. The company can access long-term capital, therefore has good long-term growth opportunities. So they can get long-term capital, therefore there's more growth opportunities for expansion and growing the business. Remember, we have more shareholders, which also will help with that growth and expansion. The company is a separate legal person, so it can purchase assets in its own name. So the assets that are bought will be under the company's name. Therefore, if the company is struggling, they will take the assets from the company and not from the individuals themselves. Now the disadvantages of a private company. Private companies are subject to many legal requirements and regulations which can be onerous. Decision-making takes time because of the large number of people that are in management. The private company cannot be listed on the stock exchange, therefore it cannot sell shares to the public. So yes, they can sell privately, but the disadvantage is they can't sell it publicly because private companies just can't do that. Directors may sometimes act in their own interest and not in the best interest of the business. Annual financial statements must be reviewed by a qualified person, which is now an extra expense that we need to take into account. Difficult and expensive to establish as a business as it is subjected to many legal requirements. We need to register for tax. We need to register the name. We need to register the business. So there's a lot more legal requirements in registering a private company versus that of a sole proprietor or a partnership. The private company pays tax on the profits of the business and on declared dividends, and therefore it is subject to double taxation. Directors may sometimes be held liable for the debts if it can prove that they have committed fraud. Some shareholders may not exercise their voting right in choosing the wrong person as a director. Just going to read that again. Some shareholders may not exercise their voting rights, resulting in them choosing the wrong person. So not everyone is forced to vote for the director. So sometimes the director might be the wrong person. And then if we go a couple bullets up, where it says directors may sometimes act in their own interest and not of that of the company. All right, personal liability company. Okay, definition of a personal liability company. A personal liability company is mainly used by associations. So we're looking at lawyers and like accountants. The name of the personal liability must end with INC, which means Inc. Incorporated. Sorry. Directors of the company, as well as the previous directors, will be responsible for the debts of the company. So, the characteristics of a personal liability company. A personal liability company is required to have a minimum of one director on the board of directors. The memorandum of incorporation can be altered to require more than one member on the board of directors. Directors have unlimited liability and they are jointly liable for the debts of the business, even if they are no longer active in office. Can already see that one as a bit of a disadvantage. The memorandum of incorporation could state that it is a personal liability company. Advantages. Okay, the advantages of a personal liability are the same as those of a private company. Well, there you have it. Now we are halving the work because you need to study the advantages of a private company, personal liability, same. Okay, the disadvantages are also the same as a private company, except that the directors have unlimited liability. So again, there we're halving the work once again. Okay, so you can just go back in the video, look again at the advantages and disadvantages of a private company, and that's going to tell you what are the advantages and disadvantages of a personal liability company as well. Public company. Definition of a public company. Now, before I start, I've seen it as a trend that they like to compare a private and a public company, so just be aware of that. So they could compare the characteristics, the advantages, or the disadvantages, or even the definition. Okay, so just be mindful of that when studying, because I've noticed they like to compare the two. Okay, so again, private versus public. The public company is a company that is registered to offer shares and stock to who? The general public. Private company sells shares privately. Public company sells shares publicly to everyone. Right. Public companies are trading in the open market called the Johannesburg Stock Exchange in order to raise capital. Ownership of a public company is distributed amongst the shareholders through the free trade of shares and stock. The characteristics. There's a minimum of one person that can start a public company. The name needs to end with the letters LTD. Okay, again, there you can see the difference. A private company was PTY Ltd. This one is just Ltd, just limited. Shareholders have limited liability and are not personally liable for the debt of the business. Individuals can own shares in the company, and these shares are freely transferable. A prospectus is issued to the public to invite the public to invest in the company in order to raise capital. A public company has a separate legal personality and therefore it has unlimited continuity. So again, I feel like I've said this a billion times in this video. Legal personality, legal entity means that you are separate from the business. So again, business is struggling. They're not going to take your personal assets, and your personal possessions. Okay, once again, a public company has a separate legal personality. There's just a bit of a repeat there. It requires 3 or more directors and 3 or more shareholders. You see the difference there as well. Okay, 3 directors, 3 shareholders. Profits are shared in the forms of dividends in proportion to the shares held. A public company is required to hold an annual general meeting where shareholders will elect a new board of directors. It must register with the Registrar of Companies by drawing up a memorandum of incorporation. Raising capital by issuing shares to the public and borrowing capital by issuing debentures. Auditing of financial statements is compulsory, and audited statements are made available to the shareholders as well as the public. So remember, because they can sell shares publicly, all of this now, the financial statements and all the audits are going to also be made available to the public as well. Alrighty, advantages. Public companies enjoy the ability to raise funds through the sale of the company's stock to the public. Okay, the business has its own legal identity and can own assets and property in the business's name. It's managed by at least 3 competent directors and highly skilled directors. Directors bring creative ideas which encourage innovation and high productivity. Shareholders can sell and transfer their shares freely. The ability to raise large amounts of capital in public exchanges enables the business to carry out their capital incentive activities. So because they're selling publicly their shares, that means they have more access to capital, meaning there's more chance of expansion, more chance for growth. These are these capital intensive activities that we are referring to. Strict regulatory requirements to protect the shareholders are in place. It's easy to raise funds for growth through the sale of shares, like I've said. Additional shares can be raised by issuing more shares or debentures. There's no limitation on the number of shareholders, so the growth and expansion is not limited. Shareholders have limited liability for the debt of the company and may lose only the amount that they have invested. Again, that's where we talk about the legal personality. They cannot take your personal possessions, right? The management of the company can improve since directors are accountable to their shareholders. Why are they accountable? Because they need to have these annual general meetings, the voting, and the audited financial statements. The public has access to information, and this could motivate them to buy shares from the company. Now on the flip side, the disadvantages of a public company. Public companies are vulnerable to increased scrutiny from the government and the public. Okay, they could be scrutinized depending on the financial audits that they are sharing, their financial statements, maybe the annual general meeting. So because they're making this information more freely available to the public, it also opens them to scrutiny, and people could tell them or suggest that they are using their money incorrectly, or they're wasting money in certain areas, or whatever. It's difficult and expensive to establish, as the business is subjected to many legal requirements. We have to register the name, register the company, and. They must prepare their financial reports in accordance with the generally accepted accounting principles, GAAP. Directors may not be motivated to work very hard because the shareholders decide on the director's remuneration. Directors may not have a direct interest in the company, which will slow down the growth and the profits. Increased director fees will increase the expenses, and therefore if we're increasing the expenses, we are also going to then reduce the amount of profit that we're making. Some shareholders may not exercise their right, resulting in choosing the wrong person as director. Choosing the wrong person, they might not have an interest. Therefore, again, we're going back. This can affect the growth and the profit of the business. A full financial report must be submitted to the major shareholders every year. The large management structure can result in longer timeframes for decision making because now it needs to be approved by this person and then by this person and, right? So it could slow down decision making because we just have such a large business with so many people involved and a lot of management and all of that. Auditing of financial statements is compulsory. Right, exactly what I said. Private company versus public company. Right, cute little pictures there on the side for you to see. So, private company. We cannot offer shares to the public. They are not freely transferable. Why? Because we can't share them to the public. We need one director. The name must end in PTY. Audited financial statements need not to be audited or published. Remember, everything is private. It does not need to publish the prospectus because it doesn't need to trade the shares publicly. The company is not required to raise the minimum subscription or issue a minimum amount of shares. Now on the flip side, a public company. They can trade publicly, so they can publicly trade on the JSE. Shares can be freely transferable. 3 directors. Names need to end in LTD. Annual financial statements need to be audited and they need to be published to the public. Remember, we can, public company, sell our shares publicly. Therefore, our annual financial statements need to also be shared publicly. Okay, here are the keywords I'm using. Public, public, public. Have to register and publish a prospectus of the company and the Intellectual Property Company Commission. They must raise a minimum subscription before the commencement of the company. Okay, very nice question, especially for an essay. So it's a very nice question to ask. Then we have state-owned companies. Right, different from public companies. Okay, I used to think in the past that I used to confuse the two. But state-owned companies are different. Why? Because it says in the word it is owned by the state, by the government. Okay, in a state-owned company, the government is the major shareholder and it falls under the Department of Public Enterprise. So it is still a company, right? Just it is now owned and it falls under the Department of Public Enterprise. These companies perform specific functions and they operate in accordance with a particular act. They take on the role of commercial enterprise on behalf of the government. So examples are, they include South Africa, which includes Armscor, Alexcor, SAA, Eskom, and Transnet. There's a couple examples there below as well. So these are examples of state-owned companies. The characteristics. So the state-owned company is financed by who? The government. State-owned, therefore it's owned by the government, so all the finances are going to come from the government. The name needs to end on SOC. The SOC is listed as a public company. Don't let that confuse you. It is listed as a public company, but who owns it? The state. Okay. These enterprises are managed by the government and not by individuals. It requires 3 directors and 1 or more shareholders. SOCs are registered with the Register of Companies by drawing up a memorandum of incorporation. The Act imposes personal liability on the directors who knowingly participate in reckless or fraudulent business acts. The state-owned company must have its financial statements audited, and a state-owned owned company is compelled to hold an AGM, which is an annual general meeting. A state-owned company has a separate legal personality, and the shareholders have limited liability. So again, it is seen as its own separate entity by itself. So the advantages. SOCs help to eliminate economic exploitation and oppression. They offer essential services which may not be offered in the private sector. Shareholders have limited liability. Profits may be used to finance other state departments. Wasteful duplication of services is eliminated. There can be jobs that are created at all different skill levels. It generates income to finance social programs. Prices are kept reasonable to make services affordable to more citizens. It provides healthy competition to the private sector companies because the government makes their contributions. Most of SOCs are run on sound business lines as they have their surpluses to run their projects. An SOC is a company that has its own separate legal personality. Now the disadvantages. SOCs usually suffer from inefficiencies in management. Management of SOC does not implement new ideas and innovation. Losses must be covered by the taxpayers. Okay? Government can lose the money if the business fails. Got a couple of those examples, but I'll leave them out for this video. I'll leave that to call it your imagination, right? Shares are not freely tradable, making it difficult to raise capital. A lack of incentive for employees to perform as they don't share in the profit of the business. They often rely on government subsidies, which may not cover all the business expenses. SOCs must follow strict regulations for operations to raise capital. The management of the SOC must attend the AGM, and SOCs are compelled to have their financial statements audited every year. Alrighty, non-profit company, the one that does not make a profit, right? Definition. This is a legal entity, again, so now we're seeing it as separate to the person themselves, right? It is organized and operated for a collective, public, and social benefit. They include churches, charity organizations, and cultural organizations. The primary objective of an NPC, non-profit company, is to benefit the public and not to make a profit. Characteristics of NPCs. The main aim is to provide a service and not to make a profit. They are funded by donations or by foreign funding. The name of the company must end with NPC. All profits must be used for the primary objective of the NPC. Profits, when we're talking profits, it means, okay, if we are, most charity shops will, or charity organizations will have like a little thrift store, right? So they're selling books. They are getting money in, yes, but it's not necessarily profit, if that makes sense. So they're making money, they're getting an income, right, from selling these books, but they receive these books as a donation. So all the money that is made in the business needs to go back into the business. That's why it's not a profit company. So don't let that profit word confuse you. It's more to say, if there's any money received from selling things, they need to put it back into the business, because the primary aim is, when we go back again, to provide a service for the community. It must prepare a memorandum of incorporation. Qualifying NPCs are granted tax exemption status, which means that they don't pay tax. The board of an NPC must comprise of at least 3 directors. NPCs do not have share capital. Therefore, they cannot distribute shares or pay dividends to their members. So they can't sell shares privately or publicly. So what are the advantages? Profits are used solely for the primary objective of the business. The business does not pay tax, so all the earnings that they get can be cycled back into the organization to improve it. Donations made by donors are tax deductible. Therefore, it motivates people to donate to these organizations. Employees of non-profits are not personally liable for the debts of the non-profit. The liability of the members is limited. An NPC's existence can last long after the founders have left the business. Because again, it's seen as a separate entity and personality. Therefore, it can operate and exist even if the partners have left, even if the partners have died or they have retired. It can receive grants or aid from the government. A surplus of income is retained for the future of the goals of the business. It must prepare the financial statements at the end of the year, but it is not compelled to audit these statements. NPCs are not compelled to hold annual general meetings. Now the disadvantages. So they need professional assistance to set up this type of organization. It does not generate enough capital to cover their costs. I think about charities, there's one down the road where they take in and they look after children. And I mean, they often put out notices where they need money for food or money for purity, money for nappies. So that's definitely a disadvantage because sometimes there's not enough donations or there's not enough money raised to actually buy the things that they need, right? Donations may not always be enough to finance the company's expenses. Assets are not distributed to the members upon closing down. Creating an NPC takes time, effort, and money. I think a lot of patience as well. Obtaining grants can be slow and a tiring process. Incorporators cannot take along assets accumulated by the NPC if they decide to leave. So because the people who are running the non-profit are separate from the actual non-profit, any assets that are in the business, once you leave the business, you can't take those assets because they are owned by the business and they are there for the purpose of the community and for the business. So anything that is donated, raised, it can't be taken from the owners if they decide to leave. They are not allowed to pay bonuses to the members. They are compelled to prepare annual financial statements. The annual financial statements, I think, just show, especially with a non-profit, that they are using all the money, all the money that they're making is going towards the business and the good of the business, and that the owners are not taking a profit from this. All right, different types of co-cooperatives. Okay, so we've got a little diagram there on the side. So a cooperative society is a voluntary association that is established with the aim of service to its members. It is a form of business whereby people with similar interests link for promotion for common goals. A cooperative is a traditional way for a group of interested parties to come together and share resources, infrastructure, and cost to achieve a better outcome. Okay, so we've got the producers. Then we have the marketing societies, credit societies, housing, and farming. Right, so the types of cooperatives, there they are. Housing, worker, social, agricultural, cooperative, burial society, financial services, consumer, and transport. Okay, the characteristics. A minimum of 5 members is required to start a cooperative. The words Cooperative Limited must appear at the end of the name. They have a democratic structure with each member having one vote. They are motivated by service rather than making a profit. They are managed by a minimum of 3 directors. Members own and run the business together and they share equally in the profits. It is a legal entity, so it can own land, it can own assets, and it can open a bank account. Remember again, legal entity, legal personality, separate from the person themselves. Register with the Register of Cooperative Societies. The objective of a cooperative is to create mutual benefits for its members. The advantages and the disadvantages. So, the advantages, they have access to resources and funding. Decision making is done by the group. Members have limited liability, meaning because it's a separate entity, they can't come take your personal possessions. The decisions are democratic and they are fair. Cooperatives have continuity of existence. Profits are shared equally amongst the members. Each member has an equal share in the business. A cooperative can appoint its management. Members are motivated because they are working for themselves. It can gain extra capital by asking its members to buy shares. Resources of many people that are pooled together to achieve common objectives. Now the disadvantages. It's difficult to grow a cooperative. Shares are not freely transferable. There are very few promotion positions for staff. Decisions are often difficult to reach and they are time consuming. It can be difficult to get a loan because their main objective is not always to make a profit. The success of the cooperative will depend on the support of the members. All members have one vote regardless of how many shares are held by them. All right, here's a very big diagram. Don't get overwhelmed, it's really not that much. We're just taking a summary. So we're taking every form of ownership. We're saying the name of the business. Is there formalities? Must they register? How many owners? Is there continuity of existence, personal liability, and profit sharing? So it's a nice overview and a summary of all the different types of businesses. So pause the video at this time and go through this. I would even maybe jot this down, take a screenshot. It's really nice while you are studying because you have all these keywords and immediately you can highlight and pick up which ones are similar, which ones are different, and therefore get this commonality. Like we can see sole traders and partnerships are similar. Why? Because they don't need to have a name. There's none for both of them. Legal personality, neither one needs to have legal personality. Are you with me? The continuity, they both lack continuity. Okay, then if we're looking at some of the others, you'll also see the similarities in that. All right, there's the mind map recap. It's a very short mind map recap considering how extensive this chapter is. But there's the mind map recap. And here are the resources that I've made use of for the video for today. I want to say thank you so much for watching this video today. It is one of my longer form videos. I had to take a few breaks every now and again. I'm not going to lie to you, sitting for about an hour recording a video in one take takes quite a lot of effort. I think those that do acting and those that are in the entertainment industry could definitely relate to that. So I want to thank you for enduring the time in this video. I really hope it has helped. Again, this just builds year after year, grade 11, grade 12. So if you can understand it fully in grade 10, you're just making your job that much easier. And again, when you get to grade 11 and grade 12, can you come back and review this video? Of course you can. Okay, even for those that are in grade 11 and grade 12, you can come back and review this video and get just a bit of more a foundation and a groundwork for the video. But thank you so much for watching. If you like this video, please do give it a thumbs up. Please do comment down below. And I really hope to see you guys in my next video. Bye for now.